and welcome to Business Television India. I am Piyush Jain and you're watching Market Guru. Markets are at an interesting inflection point, couple of days away from the budget, and we have been hearing mixed cues this month. The markets have been off from their 12,000 peak on the Nifty perspective. The mid caps are still not performing. The question is now you should look at the long term or you should really worry about the short term. And also, as always, a lot of stock strategies, stock picks, and for decoding all of that, today let me welcome Mr. Chakri Lokapriya, the Chief Investment Officer and Managing Director at TCG Advisory Services. Mr. Lokapriya, welcome to the show.
Thank you.
And first question, and the question has two parts. Let's drill one part by one. First, how are you looking at the markets at present?
The markets at present are actually looking okay because the markets like certainty, and now that with the election is out of the way, and you have Modi 2.0, which will be largely a continuation of Modi 1.0. And lots of good work which has been done in terms of the bankruptcy code, NCLT, GST, all that will see a more greater clarity and a rationalization which is needed for the market. And so from that perspective, I think as these things clear out, I think the markets will stabilize and move higher as the economy also cyclically moves higher.
Right, and from that perspective, the second part, a lot of viewers, they either would be holding mid caps, they would be thinking about let's now invest in mid caps, because what we were telling again, what we were hearing before the elections, that it's time to be in safer pockets, be in large caps. Now the elections are over, and then when we want to invest in mid caps, the market situation, whether you are seeing the sort of underperformance or you are seeing the global markets or all the cues, they actually are making you slightly feel, I should say, hesitation is there, or slightly scared a bit again from the viewer's perspective. How we should look at mid caps now?
Your observation is absolutely right in terms of if you look at large caps, it's actually up about 7 or 8% year to date, whereas mid cap is negative. But if you rewind back and look for the last 5 years, the large cap returns index has roughly been about 10%. And the mid cap index has been about 7%. So either whether it's large cap or mid cap, neither one of them is overheated. Second, I think it's a fallacy to believe that large cap is less risky than mid cap. As a case in point, it's quite interesting to note that 19 of the 50 companies in the Nifty which existed 5 years ago are deleted from the Nifty 5 years later.
And it happens every frequently, every 5 or 10 years we see new companies coming into indices.
And all these companies which have been deleted, some of them were mergers and acquisitions, etc. But many of them, whether it's BHEL, DLF, Punjab National Bank, all market leaders at one point in time were down 70-80% and therefore deleted from the index. So I would say that it's not that mid caps are less riskier or more riskier. I think the focus now has to migrate into both large caps and mid caps because the market is not overheated.
So where we should focus now? What should be the point of focus, both from the valuation perspective and both from the sort of new 5-year vision perspective?
I think we are starting off with a clean slate in terms of, given that the new government is in place and they have a fairly clear idea, but they have highlighted about 12 areas of growth: infrastructure, irrigation, women empowerment, Make in India, and many more things like that. So all this will allow you to, invest in each one of these sectors, which provides you a good runway for growth by 2025, where they want it, and we believe that it can be a $5 trillion economy. Currently, it's $2 trillion, so which means it's a 2.5 times growth, and I think it's doable.
Right. So from that perspective, the last time we saw again the road EPC companies, they did really well. Couple of again, as you were just pointing out. Now, if I quickly again point out, road is one space, infra again is one focus. Then you have wastewater treatment, that again was part of the election manifesto of BJP. And then you have the traditional rural focus again, where they want to again improve the livelihood, the sort of farm income perspective here. From this perspective, how you actually go down to the selection of stocks? Which stocks actually come to your mind, which you're liking right now?
Yes, let's look at each one of these areas and some of the companies that you can see that you mentioned EPC companies. Now clearly, many of these EPC companies have actually repaired their balance sheet, lowered their debt, tried to reduce the working capital cycle number of days, and today are far healthier companies than they were 5 years, 4 years, 3 years ago. So if you take a company like PNC Infra, the company has hardly any debt. It has a very strong order book, good visibility for at least for the next 2 or 3 years. The government's thrust is into build more roads and highways, etc. So from that perspective, the stock is trading probably about 12 times FY21, and so from that perspective, the valuations are also there, are attractive enough. So I think that's one. Companies like this, there are several other companies, KEI Industries, Nagarjuna Constructions, and all of them kind of fit the bill in the infra space.
Right, but NCC I think at present has been seeing delayed executions. So versus NCC, if you want to compare with KNR Construction or the other companies again like PSC projects, what do you actually want to do really again for selecting infra companies or road companies?
I think it has to be different approaches for different stocks, as you clearly would agree. Now, in the case of Nagarjuna Construction, it's a company which has its order book, which is fairly well diversified across
more than 35,000 crores.
Indeed. And it has seen some weakness lately after the change in government in Andhra Pradesh and some fears of order cancellations. And even if indeed they are cancelled, that would be a very small percentage of their overall order book. And given that its overall valuation is actually still very attractive, it's probably trading at under 10 times. From that perspective, the revenue visibility is there, the fairly well diversified order book, and it has corrected lately. And therefore, these are the kinds of stocks I would clearly buy from a 3-year perspective.
Right. So, are these stocks, now we have seen again PNC Infra again has rallied a lot, while again NCC is still lagging behind, there is still PSC projects again still is far off again from life high levels. Is this something where you think the valuation catch-up will continue through the year? Investors can keep on again adding these stocks? They are still looking attractive at present?
They are looking attractive at present because, given the fact that budget is just about around the corner, I guess people are waiting and anticipating, and there's some amount of uncertainty and anticipation. So as these things clear out, and at least the government has very clearly spelled out in its election manifesto, and which is largely a continuation of what they said before the election in Modi 1.2.
I want to read into what you're thinking is the last time everybody was expecting of a huge spending. We saw a subdued spending, but still a large spending compared to the 5 years before that. This time, are you really expecting, because the manifesto has promised a lot, it has not promised a similar infrastructure spending, it has promised much higher spending. So, but are you expecting in this budget, this time, we could be hearing that amount of large spending, some really path-breaking reforms to generate money, because then again, it can also translate into a very strong sentiment for the road companies also.
I would not really look at the path-breaking reforms. I would look at whatever they've done, and incremental doing it is I think more than sufficient in terms of companies growing their earnings. Now, if you look at a 5 trillion, for instance, where the economy is currently 2 trillion, that's 2.5 times over the next 5 years, roughly translates to about 16-17% CAGR over the next 5 years. Now, can infra companies, EPC companies, or for that matter, some of those various election manifesto companies grow that kind of thing? Answer is clearly yes.
Right. So that's road is one segment where there's clearly bullishness. Second, what category of stocks? Which stocks again are you liking at present?
You'll also see the emergence of lots of new sectors. And for instance, they've talked about Yuva Bharat or women empowerment. So for young India, you would need lots of new types of products and services that appeal. And right from, payment companies like Paytm, which will go public in probably a year or so from now, you will begin to see emergence of lots of new companies as well. And so those are companies that we will focus as well. Second, for example, women empowerment, whether it's safety related issues for the women or hygiene or security. And you have a number of companies which cater to hygiene and health and insurance. And so those are companies that we'll clearly focus on.
In hygiene again, which are there any listed companies which will you be focusing on?
Yes, for instance, you have Procter and Gamble. You have all these various sanitary pads manufacturing companies, and so these are all companies which are from even now they can demonstrate very strong growth, revenue and earnings growth.
Valuations are attractive?
Valuations are kind of expensive for some of these companies, but given that the growth out there and the under-penetration in the market, I think there's sufficient room.
Okay, so that's another pocket. The third pocket, what's your opinion around the industrials, the wastewater treatment, or the engineering companies? What's about that pocket? What's the feeling there?
Within, I think that...
I can then extend that later to building materials and other space.
Indeed, indeed. From that perspective, clearly cement plays a role in the whole thing, in all kinds of infrastructure or engineering or building. And if you look at any of these cement companies, whether it is Ramco Cements in the south, they just completed quite a good chunk of their capacity expansion, so that's out of the way. Now you'll have their operating metrics, which will improve as you go down the next couple of years. Heidelberg Cements, it's strong in the central India, its capacity is right up there. The company will show good ROEs as demand expands. JK Cement, white cement, which is a good product, and also a clear market leader. And all these companies, notwithstanding the cartel kind of fears, if you look at cement companies last 4 or 5 years, they have not been able to increase prices much above inflation. So which means there's a question of cartelization. So I think the volumes are on their side. Even with some amount of operating leverage, they'll do really well.
Right. From that perspective, choice is mid-cap cement company like Ramco or the large cap?
I would look at more the mid-cap companies. Of course, Ultratech Cement is there all over the country.
The valuations are rich.
Valuations are rich. So I would look at, therefore, the mid-tier ones. I'd also look at Ultratech because, they're there, the national presence allows them a certain amount of premium to their multiple. But Ramco, Heidelberg, JK Cement, JK Lakshmi, they all look good.
Okay, so you got a couple of names in the cement pack also, the large cap and the mid cap both. We talked about cement, we talked about again some road companies also. What at present you've been investing, buying, or you've been liking recently?
I think clearly some of the government companies, because like Engineers India, or even for that matter, some defense related companies like Bharat Electronics. Now these are, in the case of Engineers India, clearly whether it's petrochemical or oil refining, both important areas, government owned companies, big order books, revenue visibility is fairly strong, and the company is enjoying fairly decent margins. So as long as the government doesn't play around with its profit margin, the amount that it can earn, because they do that with some of the other companies, in that case, I think the valuations are very attractive.
From the dividend yield perspective?
No, both from a growth perspective, because if you look at Engineers India, I think its earnings should grow well in north of 15-20%, and it's probably trading at about 12-13 times.
Right, and BL also again the Akash missile program is something which the investors are waiting for again to get more cues on the earnings. From the BL perspective, is it something where you are also bullish on the shipyard companies or the companies which are catering to the defense from the Navy side, like Garden Reach or Cochin Shipyard? I'm trying to extrapolate again, see again if you like there also.
That's a space which I haven't really done much work, so I wouldn't be able to comment on individual names. But clearly that whole space of, even because some of that space, if you include warehousing and logistics, those are clearly areas of growth. And, whether it's a container corporation, shipping goods from the port to the hinterlands. Now, all these companies will begin to see, I think for that you need certain more amount of, because, there's a limited amount of budget that the government has. So while there are lots of areas, they can focus probably only on a fewer areas.
Right. And from that perspective, broadly, where do you see the markets, the benchmark indices, stocks we have been again talking about, but while I was talking about the stocks, I was just thinking again where perhaps you would be seeing at the end of FY20, we are almost 3 months now into FY20, at the end of FY20, how do you see the markets, largely flattish, totally stock specific trade, or you see the second half to be much better than the first half?
So if you look at the last 3, 5, even 7 years maybe, a lot of it, the Indian stock market has been held back because of lack of growth in corporate India. Corporate earnings have actually grown only about 5 or 7% about 6 to 9% over the last 6-7 years. Now that is not a strong growth. And what is the stock market returns over the same period has been roughly about 10% for the large cap and lesser for the mid cap. So clearly that's not an overheated market. Over these last few years, what you've had is the companies have deleveraged themselves. You have the IBC, the bankruptcy code.
Lot of provisioning.
Lots of provisioning has happened. Banks are becoming healthier. So I think we are somewhere more than halfway down that cleanup process. And so as the cleanup process completes and accelerates, only after then we will see a revival of earnings. So I think in fact FY20 will see a downgrade of earnings rather than an upgrade.
Right. So from that perspective, any sort of risk to the valuation multiples or the sentiments, broader sentiments, what's your thinking on that?
I think the sentiment should be largely, as long as the government is progressive in its announcements, that is, there is this talk about GST cuts across various products, which I think
is expectation, but isn't it too hard because the fiscal is not in
indeed
shape.
So I think it's unlikely that anything meaningful will happen. Again, corporate tax cuts unlikely to happen. Hopefully they do not increase taxes for individuals or introduce inheritance tax or estate taxes, because that's very detrimental. So as long as there is no negative, that in itself is a positive, because overall cyclically I think the economy is looking up, so it's best not to rock the boat.
We have seen the fourth quarter earnings. We also saw again third quarter earnings, though it was an exception. There were a lot of hiccups. There were a lot of again liquidity issues. But when you had a look at the last 2 quarter earnings, where do you assess at present the momentum lies in? Because if you look at the earnings, IT largely in line in terms of performance. When you take a look at the energy, it was all over the place, barring Reliance Industries. OMCs again, they were struggling. When you take a look at consumption, the volume growth started tapering down. When you take a look at the pharma, again all over the place. I'm just listing out the sectors for you. So what's the sense you're getting in terms of earnings momentum as you move towards FY20?
I think earnings momentum you largely see in the most cyclical sectors like banking, because the last year the earnings were largely negative, and so the earnings will look really strong.
Base should be attractive.
The base should be attractive, and therefore the earnings growth rates will look very strong. Same thing for many of the infra companies, where because the execution had slowed down in the last several months, and therefore that will improve. So that as a space, the infra industrial space will pick up. IT will continue to do its standard growth rates that it has done last year, this year, because the US economy is still looking very, very strong. And so both your frontline companies.
You don't see any slowdown in discretionary spending.
In fact, it's moving at a very healthy clip.
That's good for IT then.
And so it's clearly good for IT. So whether it is your frontline TCS or even your mid-cap LTI, Larsen Infotech, they're looking extremely nice. And healthcare is more a company-specific issue because of the FTA. So if you add this all up together, I think FY20 will probably end up at about 15-18% earnings growth versus the 25 market is projecting. But that in itself should not derail the market, because I think earnings in this cycle is less important than the recovery that you will see.
Want to ask you again, since you mentioned the private banks, what's your sense on the sort of treasury, bumper treasury gains, I should use the word here, that, which again are coming our way? Good news for banks, though the wild card will be how much you're holding in the available for sale category. But broadly, treasury gains, bond yields have been falling sharply. There has been a good rally in the bonds, and still, as we have been talking again, the experts have been still bullish in the context of bond rally. How do you see that as a tailwind for the banks?
Clearly, it's a very big tailwind, and companies like SBI will benefit very strongly from it. Less so probably for the private corporate banks, but more so for the PSU banks. And so then largely the discussion, I think the way I'm approaching it is whether the bank will be acquired or or it's an acquirer. So I'd rather stay away from the acquirer PSU banks, and so that is the only overhang on PSU banks. Otherwise, their valuations are looking very, very attractive.
Right. Anything you like in the PSU bank?
It's clearly SBI. They have indicated that they're going to postpone their fundraising because they don't really need the capital and they want a higher valuation. Whether they postpone it, or even if they do it now, I think the stock trades at one time, so there's more than sufficient upside. Now, Union Bank, Canara Bank, depending on whether it's, I think if they're acquirers, then it's a question, but they trade at half-time book value. Things like that, we're clearly looking at.
And private banks, which will be a topic, or if you have been liking something?
Private banks, I think, is among the other than the ICICIs and the Axis, I think RBL is looking good. It's a company which has expanded its branch network very strongly over the last few years. I think that capex will kind of taper down going into the end of next year.
So you see improvement in the cost to income ratio and
margins. Cost to improvement ratio, and you will see greater break-even, quicker break-evens of the individual branches. Its ROAs and ROEs should improve. It's trading at 2.5 times book. And mind you, while it went public recently, its bank has been around from, I think, 1946 or something like that.
Right, so old bank.
It's an old bank.
Right, so those are a couple of the names you've discussed. One question I want to ask you from the perspective of what we have been looking in the market, how much we should be now concerned about what was happening with the NBFCs, with the liquidity situation right now, how much it is relevant for you. Now we can talk about whether it's Z exposure or SL group exposure or Jet Airways. These again, they keep on coming back again. But in the context of entire sort of market sentiment, how much this is still relevant and important at present?
Clearly in terms of the NBFCs, the loan growth rates dramatically will come down from the 40% plus to some more lower number, maybe 15%. Along with that, the valuations also will come down, have already come down. They already trade, most of them have created a good 40-50% over the many years, over the last 1 year or so. So against that context, I think this asset liability mismatch liquidity thing will continue, tightness will continue for the next couple of quarters. The RBI is doing a great job in providing liquidity. So, this asset liability mismatch as it is fixed, I think still, the well-run banks, well-run NBFCs clearly have their space, but I think you will still see a lot more default in that space in the coming several months.
Right, so that again should remain something which is going to again trouble the markets. But from that aspect, perhaps the last question in our conversation, how much at present the weightage or the relevance of the consumption pack still remains? It's a consumption economy, so obviously they will remain relevant always. But how much now we should give credence to the fourth quarter performance, where there was a moderation in the volume growth, and between large caps, mid caps, if you like anything in the consumption space, what would that be?
Consumption, is clearly linked also to the NBFC tightness, as the liquidity tightness in the NBFCs led to a hike in interest rates, greater EMIs went up. As a result, big ticket items like autos, automobiles came down. So that is unlikely to reverse itself anytime in the next 6 months or more. The smaller ticket items, when it comes to volts, buying an air conditioner or items like that, I think those will pick up.
And they indeed actually, the June quarter data is extremely robust.
Indeed. So I think that's as a space we'll see pick up because it's easier on the pocket. And then I think now as far as automobiles itself is concerned, now you'll have to ask yourself certain structural questions. If you ask the Niti Aayog person who is talking about completely electric vehicles by 2030, so which means just 10 years from now. So what happens to all the automobile companies? So which means if they're not able to adapt themselves to electric vehicles, many of them won't be around.
Right. So that's something which is going to be important even for the ancillary companies again, if again you're looking from the automobile perspective here. But since we're running out of time, last quick question to you, where we are right now, what will be that 1 or 2 main expectations from the budget from your perspective?
I think the biggest expectation would be no new taxes, and a continuity of the existing policies is more than sufficient to take the market much higher.
Okay, so that's the expectation coming. Thanks a lot, Mr. Lokapriya, again as always for coming on the show and giving us insights. And that's all we had on this edition of Market Guru. Thank you so much for watching us.